Hello and welcome, everybody. Give everyone just a moment to get connected to audio. Share my screen while we're doing that. Okay, awesome. Can everyone see my screen? Give me a thumbs up if you can. Perfect. Thank you so much. All right. I am so glad you guys are here today, and I'll kind of let other participants in as they join us. But I'm glad you're here, and I want to get us started so we can make sure that we cover everything. There's a lot of information to cover today. Student loans are a very complicated topic, so we want to make sure that we get as much information to y'all as possible. So first, let me introduce myself. My name is Sarah Lorenzen, and I am an outreach specialist and a certified financial education instructor with Oklahoma Money Matters and Ready, Set, Repay, which are two outreach initiatives through the Oklahoma State Regents for Higher Education and the Oklahoma College Assistance Program. That is a whole lot of words to basically say my job is spending 40 hours a week, sometimes more, educating students about their student loans and their budgeting and making sure that they are financially well. And it is a job I've been doing about 4 years now. I've been doing the financial literacy thing for about 7, and I just really love doing this. And I'm glad to have you guys here today. This is one of my favorite topics to talk about because I myself, as a student loan borrower, is definitely something that is always at the forefront of my mind. And there's a lot of things that no one explained to me when I took out my student loans. And so I definitely like to make sure that you guys have that information. So that being said, we open this call to a lot of folks. So we've got folks who are students and parents and educators. So I just launched a poll, and what I would like you to do is just very quickly take a second to tell me who you are. If you are just a student loan borrower, if you are a student that is currently in college and kind of wants to know what to expect, if you work with students, go ahead and let me know. All right, great. So we got a great mix here. We got some college students, some folks who work with students, and some counselors. I am so glad that y'all are here today. I definitely like doing this poll just because it helps me know who's on the call, so I can make sure that I'm giving you the information that everybody on the call needs. So let's go ahead and get started, because as I said, there is a lot to cover. So a few norms, things to keep in mind as we proceed, and this makes sure that you and I both get the most out of this presentation. The first is I'm going to say that as of this moment, as of today, this is all accurate information. As we know, if you've been following it all in the news, stuff with student loans has been changing almost by the minute. We are currently waiting the Supreme Court decision on President Biden's student debt relief plan. The payment pause has been going on since 2020, and that is set to end soon. And details are coming out and changing almost every day. So that being said, it's important to keep in mind that this could change. And it's really important to make sure that you keep an eye on the news to see what's going on with this. Also, I am used to being in a classroom, so I love when I can see your faces. If you don't feel comfortable or you're not in a place to turn on your camera, that is a-okay. But if you feel comfortable having your camera on, I would love to see your faces. But I am going to ask that you stay muted, because this is being recorded, so folks can hear this later, and I want to make sure there's no weird background noise. I'll definitely make sure to do the best I can to keep my dog from barking downstairs. He's a little crazy, so I can never predict, but I'll do the best I can with that on my end as well. But I do still want you to be interactive. So if you have any questions or comments or things that you want to add to the conversation, please feel free to put it in that chat, because we definitely want to make sure that I'm answering all of your questions. And while this is planned to be an hour, I am happy to stay on a little bit later if any of you have any questions that I can answer for you. And the one thing I will say, especially with student loans, this tends to be a hot button topic for a lot of people. So I am going to say that we are going to approach this with respect for other people's opinions. If anybody puts that in the chat or says anything, we're going to make sure that we're being respectful. So sort of the agenda today is first, we're going to talk about the types of loans. We're going to talk about your repayment options. I'm going to talk about what you need to do today to be ready for student loan payment restart. It was announced actually just yesterday that for sure the payment pause is ending at the end of August. Student loan interest is going to resume in September, and your payments are going to start again in October. What day in October? That's going to depend on your servicer. And we'll talk a little bit about how to figure out all that information here in just a minute. I'm also going to talk about options like deferment and forbearance, income-driven or income-based repayment plans, if you're having trouble making those payments or if you anticipate that you might. I'm also going to talk about refinancing your loans versus consolidation, because sometimes there's confusion about the difference between those two and which is a better option. We're also going to talk a little bit about forgiveness and discharge programs. I'm going to talk a little bit about what you need to do if you are going to have trouble repaying your loans when the pause stops and you are going to have to start paying again, as well as some red flags to keep in mind. So that being said, let's go ahead and get started. So the first thing we need to know is that really there are two different types of student loans out there. The first are federal loans. Those, your repayment starts after you leave school or drop below half-time enrollment. So whether you graduated or withdrew, you get roughly a 6-month grace period to be able to start repaying those loans generally. They have a fixed interest rate that is set every year by the Department of Education. Unless it's a plus loan, which I'll explain what that is here in a second, they don't require any type of credit check. And there are lots of repayment options. There's currently 8 of them, and we'll talk about that here in a second as well as you get benefits like deferment or forbearance if you're having trouble making your payments. And then some federal plans are also eligible for federal forgiveness and cancellation programs, which I'll talk a little bit more about that here in a minute too. And then there's private loans. Private loans are just what they sound like. They are held by a private entity, a bank of some sort. They're going to be very similar to the structure of like a mortgage or an auto loan. They are going to require a credit check. If you don't have good credit or you don't have any credit, they may require a cosigner. They may require payment while you're in school. That is just going to depend from lender to lender. It's going to have variable interest rates a lot of the time, but even the fixed interest rates, because it's dependent on your credit, they might be a little bit lower or higher than federal interest rates. They very rarely have flexible repayment options, but again, as I said, this varies from lender to lender who you're actually taking the loans out with. And they are not eligible for any federal forgiveness or cancellation programs. So if you are someone who has a private loan, you have probably been paying on that private loan all the way through this payment pause, because the payment pause applied only to federal loans. And so going forward, that's the majority of what we're going to talk about, because private loans vary so widely and they haven't really been affected by this payment pause. So we're going to focus mostly on federal loans today. That is 97% of the loans that folks have. So that being said, there's a couple different types you're going to see, and how these different things affect you depends on the different types of federal loans you have. So it's kind of important to know the differences between them. So the first is going to be a direct subsidized loan. This happened for those of us who qualified with financial need through the FAFSA. This is what they call a need-based loan for undergraduate students. Generally, these are students who got a Pell Grant or something of that nature. We would have qualified for a subsidized loan. What that means is that the Department of Education paid the interest on the loan while you were in school or while you are in some sort of deferment. And then the borrower, once you are no longer in school, then the borrower became responsible for the interest on that loan that was starting to accumulate. I like to explain that is as if you had $1,000 that you took out the first semester of your freshman year of college, and then 5 years later, 4 years later, however long it took you to get through school, then you would start earning interest on that. So when interest started again after your grace period, you would owe $1,000 and the interest would start accumulating on $1,000. Whereas the next type, which is an unsubsidized loan, is what they call a non-need-based loan. These are available for undergraduate and graduate students, and the borrower is responsible for all of the interest on the loan from the moment it is dispersed. So we'll use that same example. If you took out $1,000 in an unsubsidized loan at the beginning of your freshman year, it will continue to accumulate interest from that moment, whether you are in a deferment or a forbearance, unless it is right now where the payment is paused on everything. And if you choose not to pay that interest while you're in school or during any kind of deferment or forbearance, it's going to continue to capitalize on top of your loan. So that $1,000, we'll say for the sake of math, you earned $500 in interest on that loan over the 4 years you were in school. That is going to get added to your balance if you decided not to pay it. And so when you graduate, you're going to start earning more interest on $1,500. And it's going to continue going from there if you don't pay the interest every month. So it's very important to kind of understand that that will add to your loan if you don't cover that cost. Okay, and then there are direct plus loans, and there's two different types of these. The first is a non-need-based loan for parents of dependent undergraduate students. So this would be your parents took out a loan in their name through the federal government to pay for your education. And then one for professional and graduate students. So folks who would go on for a master's or a doctorate, who might go to med school, law school, they will probably have a plus loan or two. This is the only federal loan that requires a credit check. And so it is very important to understand that, like, if you tried to take this out and you weren't approved, it was probably because your credit wasn't good enough to do it without a cosigner. And you, just like an unsubsidized loan, are responsible for every bit of interest that accumulates on this if you don't pay it every single month. Okay, and then these last two no longer exist, but because we have some folks who are just student loan borrowers and aren't, currently in school, they may have these older loans, like I had some of these older loans. It's important to kind of understand where this applies. So there were federal Perkins loans. This was a super low interest loan for undergraduate and graduate students that had an exceptional financial need. So that when you filled out the FAFSA told the financial aid office, this person really needs this extra help to be able to pay for their degree. And they gave them this loan. The borrower didn't pay any interest while they were in school, just like a subsidized loan. And this program ended in 2017, and loans of this type are not eligible for some federal forgiveness programs. By that, I mean things like public service loan forgiveness. That's important to keep in mind whenever we talk about PSLF here in a little bit. And then the next were federal family education loans, or what we call FFEL loans. This program ended in 2010 when President Obama streamlined the student loan things up into the Department of Education. Previously, they would have a guarantor who was a private entity, a bank or some sort of thing. And they worked with private lenders to guarantee these loans through the federal government. So it was a federal loan, but it wasn't really a federal loan. And as we see with people who have these loans, they may not qualify for things like public service loan forgiveness with this loan type, or they initially, when the payment pause started, were still having to pay their loans, because even though this is a federal loan, technically it is a privately held loan. It's not held by the Department of Education. Okay, for the sake of time, I'm going to jump through these questions, but if you have any questions, make sure you put them in the chat and I will come back to them. So first thing we're going to do is talk about when payment comes due. As we said, payment is coming due again in October for us. So it's very important if you are a student loan borrower, or if you are working with folks who have graduated since 2020, when the student loan payment pause started, it's important that we make sure that we get these things done to be ready for repayment to start in October. As I mentioned before, I know I've had a few people jump on the call since then. It has been made official that student loan interest is going to start again in September, and payments will start coming due again in October. Now, there is some word that we might have a little bit of a grace period, because as folks are sort of getting back into the groove of this, but we want to make sure that when that payment comes due, you are ready to go. So the first thing you're going to need to do is go to studentaid.gov, and you're going to sign in to your account. Now, this login is going to be your FSA ID, which is what you use to sign up for your FAFSA. If you're like me, and it's been quite a while since you had to fill out a FAFSA, what you're going to want to do is make sure that you have that login, and they can reset that login if you don't remember what it is. But once you get in there, you're going to want to update your contact information if anything has changed in the last 3 years. You're also going to want to make sure that you confirm who your servicer is. There has been lots of changes in who is actually the person that is servicing your loans. I had one change myself. I have friends who have had multiple times where contracts have ended in the last 3 years and a different servicer has taken over their loans. So make sure you know who that is, because you need to know who you're sending your payment to. All of that information is in studentaid.gov, and I'll talk about that here in a little bit, where to find that information and show you some screenshots. If you haven't already, set up your account with that servicer. You're not going to make your payments through studentaid.gov, so it's important to make sure that you get that set up. If you had auto pay, say your servicer hasn't changed, but you had auto pay before the pause happened, you need to go in and confirm that that is still the same. Make sure your bank details are up to date. Make sure that they still have you as someone who has auto pay on, because you definitely don't want to fall behind on your payments just because you thought it was set up and it wasn't. So make sure that you get that all set up. You can also go and estimate your monthly payments, so you know how much it's going to be, in case it has changed since then. If it's going to be more than what you can afford, which happens, you can go and evaluate the repayment plans and apply for an income-driven repayment plan. It's really smart to do this now to make sure that when this comes due, that you're not looking at a huge payment you're not going to be able to make. That way it's all set up in their system, and they know exactly how much to expect getting from you. Okay, once you've figured out what that payment is, you've gotten all your paperwork in, and make sure you're creating a monthly budget if you don't already have one. And if you do have one, make sure you're evaluating what things you can cut out if you haven't been budgeting for your student loan payment all the way along in the last 3 years. Roll back any lifestyle inflation that's happened since then. What I mean by lifestyle inflation is all of a sudden you had a bunch of extra money, like myself, and you found a place to spend that money. So make sure that you can start cutting that stuff out so you'll have that money available. Because trust me, it is a lot easier to figure it out now in June than to try to scramble and figure it out in October. You've got a couple of months to, renegotiate with your service providers, to cut things out, cancel memberships you don't have, and try to make that money back. And what you can do right now, since you have it in your budget, take that money that you are dedicating and throw it in your savings account. That way you're used to the money being gone. You've gotten used to it being gone, but you're benefiting yourself, because if an emergency happens, you'll have that extra little bit of money stuffed away in savings. Now, if you are a new graduate, really all of these same things apply. Except for if you want to set up auto pay, make sure that you get that set up. Depending on your servicer, those terms are different. Some of them will allow a tiny bit of benefit if you set up auto pay, like they won't charge you as much interest, you know, 0.25% or something of that nature, for setting up auto pay. So make sure that you talk to your servicer about that. All right. All right, so we're going to kind of briefly go through what the different payment options are, because there's a lot of them and they can be a little confusing. So these are the first four. The standard is what most of us, when we graduated, were put on. This is generally when you sign your MPN, what they sign you up for, which is 10 years of fixed payments, depending on how much you took out. It doesn't have anything to do with your income. You will pay less over time generally because there's less time for interest to accumulate, but this program doesn't qualify for public service loan forgiveness or a lot of the forgiveness programs, because you'll be paid off within 10 years, which is the period of time for this program. There's also graduated, which is where you will pay a little bit less in the beginning and a little bit more over a 10-year period. You'll pay a little bit more in interest, but hypothetically, as you have graduated and your income goes up, so does your payment a little bit, but it makes it a little bit easier when you first graduated to make sure you can make that payment. And then there are extended for folks who have more than $30,000 worth of debt. There's a lot of folks that have gone to like med school, grad school. It gives you the option to either have fixed payments or graduated payments, but it gives you a 25-year period to pay those loans back. You will pay more in interest over time, but your payments will be a lot lower. So sometimes that can be a little more manageable depending on your situation. Now, this first one is called Revised Pay As You Earn, or Repay. And this is the first of the income-driven repayment plans. It is 10% of your discretionary income is what you pay. You have to submit a form to apply for it every year. Once you've applied, they'll ask you to recertify your income, which is pretty simple. You just submit your W-2. When you go to studentaid.gov, they actually have a tool that will allow you to just download your information from the IRS. And so that way they can verify your income. Do keep in mind, though, if you are married, your spouse's income and debt can be factored into your discretionary income. So if your spouse makes significantly more than you, this may not necessarily be the best option. You will pay more over time. You will pay for a 20 to 25-year period, depending on when you have signed up for this. And the balance is forgiven. Normally, this balance is taxable. Right now, until 2025, President Biden signed an executive order saying that any interest that was forgiven on a federal level will not be eligible, would be taxable income on a federal level. Now, that doesn't mean if you live in a state that doesn't follow the federal tax code and they have their own rules, that you may not have to pay any interest on that. And if you're going to get forgiveness after 2025, you will probably still have that interest as taxable income. So that's important to keep in mind. Okay, the next of the income-driven plans. These are all very similar, so I'll just sort of talk about the differences here. With Pay As You Earn, which was the original of the Revised Pay As You Earn, you had to have a super high debt-to-income ratio. It was also 10% of your discretionary income, and your spouse's income and loan debt are included. You will pay more over time, but the balance will be forgiven after 20 years. On all of these, unless it is within this period of time before 2025, and if you live in a state that charges tax on student loan, which thankfully those of us who are in Oklahoma, we follow the federal tax code. So this is currently not taxable income if you get forgiveness before 2025. So that's the same. Now, the original was called income-based repayment. This is 10 to 15% of your discretionary income. They do an annual recalculation on all of these programs. And with income-based repayment, your spouse's income is not included in every circumstance. It is included in several circumstances, though. And then income contingent repayment, this one is a little bit different. It is 20% of your discretionary income or an amount that pays that loan at a fixed rate over 12 years. They have their own formula that works out which of those it's going to be depending on your situation. And at the same time, your spouse's income may not always be included. So those are all our income-driven repayment plans. And I've got on the next slide where you can see those all together. And then the last is an income-sensitive repayment plan, which are only for people who have those old FFEL loans that we talked about, those federal family education loans. And that is not does not qualify for public service loan forgiveness if we have anybody that is trying to qualify for that. Okay, so just to review, these four are our income-driven repayment plans. And we'll talk about how to figure out which one of those works best for you if you need to get onto one of those here in just a second. But if you are one of those people that is trying to pursue public service loan forgiveness, it's important to remember that these are the four plans that you have to be on in order for your loans to qualify. So keep that in mind as we go forward. All right, so let's talk about how we sign in. Once you sign into studentaid.gov, you're going to see a screen that looks very similar to this. Okay, it's going to show you your loans. It's going to show you your principal plus any interest on your loans. If you got grants while you were in school, it'll show you that too. Or if you're still in school, it will show you the current balance of what you have borrowed. It will also here on the side show you your servicer, who it is currently. So if it has changed since March of 2020, you will know. And it also allows you to pay on the servicer's site, and it will redirect you to their site so you can set up your account. And it gives you all of those details. You can also go in here and update your contact information through their website. So it will go to your servicer to make sure everything is up to date. Now, if you're wanting to find out what the best repayment plan is for you, you're going to want to go down here in this corner to where it says Loan Simulator. Once we've done that, it's going to give you a couple of options. We're going to pick, I want to find the best student loan repayment strategy. But they also have options of if you're still in school and you need to take out more money and you want to see what that's going to look like, there's an option for that. Or if you are going through a financial time right now, maybe your job still hasn't fully recovered financially from COVID. Maybe you got laid off recently. You can hit, I'm struggling with my loan payments, and it'll ask you some questions to help direct you to what option would be the best for you if you start having payment problems. So for the sake of this demonstration, we're going to hit, I want to find the best repayment strategy. So you click Guide Me, and then it's going to ask you a bunch of questions. I have a job, I filed taxes, I'm married, I have children. Click all that apply. And once you do that, it's going to direct you through this tutorial. So tax filing status, what state you live in, how much your salary is. Do you expect your salary to increase at all in the next couple of years? And then once it's asked you all of the questions that it's going to ask you, you'll see a screen like this. And it's going to say, based on what you put in, the amount that you owe, you told us that you were interested in public service loan forgiveness. You said you wanted the lowest monthly payment possible. It's going to suggest what it thinks is the best option for you. Now, if you are having a problem making your payments, it may give you a few more options, like you may be eligible for a deferment or you may be eligible for a forbearance. But we're assuming here that everybody is going to be able to make their payments. They just maybe need a little bit of help to make that payment a little bit lower. So you can also go and toggle these back and forth if you want to change what you're looking at. If you want to pay it off as fast as possible, what does that look like? If you want to pay the lowest amount over time, what does that look like? I want to choose the monthly payment that I can fit into my budget. What does that look like? If you want to pay a certain amount by a certain date, what does that look like? As well as you can toggle on and off if you're pursuing something like public service loan forgiveness or not. And if you're curious, which I always am, because even though the computer says it is, that doesn't necessarily mean that it fits for your circumstances. They have an option where you can actually look at all of the repayment plans with your details and see how they work. So you can kind of see here how it shows the different repayment plans, what you'd be looking at getting forgiven, what you would look like, where you're looking at being able to pay those off. if you are getting PSLF, how much might be forgiven, how much you're going to pay total over time. So you can make that option. And you also see down here, it says view details and apply. So once you figure out which one works best, it'll actually take you straight to the application. And if you're one of those folks looking for public service loan forgiveness, if you don't remember what I said as far as which are good for PSLF and which aren't, it actually tells you. Just make sure that you read the description on each of the plans. All right, we had a question in the chat. You said, will this email the recording to us when this is over? Yes, it generally takes us about a week to get the transcript edited and get everything sent out, but we will send it out to everybody who is currently in attendance. You will get that recording. And if you have any problems with it or you haven't gotten it within a week, feel free to shoot me an email. My contact information will be at the end and we'll get that to you. All right, so let's talk a little bit about consolidation versus refinance. There's a lot of misconception. I know I've met a lot of people that use these two interchangeably. And the thing is, when it comes to federal student loans, they are not the same thing. They have the same basic purpose, but they are not the same thing. So let's talk about the differences. So with consolidation combines all of your federal student loans into one repayable federal student loan with the Department of Education. Sometimes two, if you have a subsidized and an unsubsidized, they might give you two separate loans. But it'll allow you to have one payment for all of your loans, and it'll allow you to break down what amount of money goes to which loan a little bit easier. A new consolidation loan will have to be under an income-based or an income contingent plan. So you can't just pick all of those options. There are specific options when you have a consolidation loan. These aren't for everybody. Depending on your circumstances, this might not be the best option. It may affect how much interest you pay over time. It may change your repayment agreement. So if you have a repayment agreement that's actually working for you, this may not be the best option. And it can also affect your loan forgiveness options. What I mean by that is generally a consolidation will reset the clock on your payments. So if you are working towards public service loan forgiveness is 120 payments, if you are working on your 20 to 25 years of paying on an income-driven plan, it may reset it back to zero to where you have to start over again with those payments. So that's really important to keep in mind. But it can make older loans like your FFEL loans, your federal family education loans, or your Perkins loans eligible for programs like public service loan forgiveness. For example, in my own personal life, I found out when I started working in a public service job that I actually had about half of my loans, which were all my grad school loans, did not qualify because they were FFEL loans. So I was able to reconsolidate them all into a couple of loans, and that way they are all direct loans now. So I'm sure that they are all qualifying. So that's important to keep in mind. Whereas refinance, you combined all of your loans, federal and private, into one repayable private loan. I make sure to emphasize private loan because when you take your federal loans and put them into a private loan, you remove all eligibility for all federal forgiveness, discharge, deferment, forbearance programs. You will be subject to whatever the lender you borrowed through, whatever terms they have. And as I mentioned, that can vary widely depending on it, depending on which one you have. It is based on your credit. So if you don't have great credit, this may not be the best option because you may not get a good deal. You may have to have a cosigner. There's lots of things. And the terms and conditions do change depending on the lender. So you need to make sure if you're considering refinance that you read the fine print of every lender that you're looking at to make sure that you're getting the best deal. Okay, let's talk sort of about pros and cons of each. So the pros of consolidation, it can change your repayment term. It can either make it shorter or longer depending on the terms of your consolidation or where you've had your loans. It can streamline your loans and make them a little bit easier to manage. having, 1 or 2 loans versus like 7 or 8 if you took several out over the course of several semesters. It does allow loans that may not previously have qualify for public service loan forgiveness, because it will be a direct loan, which is the type of loans that qualify for those types of forgiveness programs. And if you've ever defaulted on your loans, it is a way to rehabilitate your loans and get them back in good standing so you can start paying again, so you can go back to school if, say, you defaulted and you lost your financial aid eligibility. The cons, it does not reduce the cost, the total cost that you pay over time. It does reset the clock on forgiveness programs, like I mentioned, and you do lose the remainder of your grace period. So if you were a student that graduated and had a grace period, if you consolidated at month 2, you would have to start making payments on month 3. You wouldn't get your full 6-month grace period. Now, it's important to note, if you graduated between March of 2020 and last May, you are not going to get an extended grace period. They're going to consider that you already had your grace period, 3 years worth of it. So it's important that you make sure that you are ready now. They're not going to give you an extra grace period just because you graduated during the pause. And another important thing to think about with consolidation is it cannot be undone. So once you do it, you can't undo it. So if you decide that it was not actually the best idea for you, you can't go and unconsolidate them once they are consolidated. All right, and refinance. They may have a lower interest rate depending on the economy, what's going on with the interest rates, your credit. If you got really good credit, you may be able to get a lower interest rate than what you were paying on your federal loans. It may streamline your loans just like a consolidation does, but with the benefit of it'll take your federal and private loans and make them into one loan, so you're not having to pay multiple payments. It can change the repayment terms. So depending on which one you sign up for, you may be paying for shorter or longer, which can affect how much you're having to pay every month, which may make it fit into your budget better. Some cons: your interest rate can be higher depending on the economy, depending on your credit. It is credit-based. So if you don't have good credit, this may not be a good option for you. And as I mentioned, you lose all of your federal forgiveness, death and disability discharge, deferment and forbearance eligibility. Now, that is not to say that the private lender doesn't have their own things for deferment or forbearance or income-driven plans or anything like that. Again, that varies from lender to lender, but you will lose things like public service loan forgiveness or getting your loans forgiven in 20 to 25 years on an income-driven plan. So it's important to take that into account if you're considering consolidating or refinancing your loans. All right, so let's talk a little bit about the forgiveness, cancellation, discharge, okay? So forgiveness is, you are not required to make these payments after a certain point due to the job you have, okay? Public service loan forgiveness is you are working for a 501c3 nonprofit, a government entity, federal, state, local, or in some sort of public education. And you 10 years, 120 qualifying payments while with that employer. It doesn't have to be consecutive, but you do have to be working for a qualifying employer, have your information or have your payments on an income-driven plan. Your payments have to be on time, and you have to make them while you are employed with that employer. You also have to have direct loans, FFEL loans, Perkins loans. Those loans don't qualify for public service loan forgiveness. You also have teacher loan forgiveness, and there's a lot of details that you can go into online for this, but this is in a public education, generally in a Title I school. You can get forgiveness up to $17,500 in student loans if you meet those requirements, as well as the Perkins loans do have their own cancellation program that you do certain things for your job, you certify that, and they can forgive your Perkins loans. And then there's options for discharge, okay? This is you stop being required to make payments because of certain circumstances. So permanent disability. Something happens, you are permanently disabled, you can no longer work. There is an option to get your loans discharged. Now, keep in mind, if you make a miraculous recovery and are no longer on disability, your loans can come back and be required to make payment again. But this is a great option for those people who have, been disabled for one reason or another. There is death discharge on a federal loan, which is really good for those of us who maybe have very high balances. We want to make sure that our families aren't getting saddled with our debt if something was to happen to us. They would just have to contact the servicer, show your death certificate, and the loan balance would be discharged. And then there's also several others that mostly are helping borrowers who were in some way, shape, or form defrauded by the school. The school closed in the middle of enrollment. Their loans were falsely certified. You returned a bunch of money to the school from the initial loan you took out, and they never reported it as refunded. And so if you can prove that, you can get that particular portion of your loans discharged. And there's a lot more. Check out studentaid.gov so you can see the details of all of those. Okay, and again, put your comments in the chat. I had put in here, but there's a lot to cover and I want to make sure that we get it all through. If you have questions, please feel free to hang on after this is all over. I'm happy to answer any questions you have. All right, so let's talk about when repayment is a struggle, or if repayment is going to be a struggle when you, come October, right? So the first thing you need to understand is there is delinquency. Delinquency starts on day one of you not paying your bills. So come October, if your payment is due October 1st and you pay it on the 3rd, you will be delinquent for a couple of days. Now, the good thing about this is a lot of people a lot of servicers will actually give you a grace period of a few days. And that depends on the servicer, that you can pay it without being considered late. I know mine, I think it's 15 days. So as long as it's paid by the 15th of the month, that is my grace period. But past that, they can report it to the credit bureau and it can mess up your credit if you have a late payment. So it's really important to make sure you're making that minimum payment, or if you're gonna have trouble making the payment, you contact your servicer before the payment is due. That way they have options to help you. And we'll talk about what those options are. Let's see. Oh, for some reason, my slide disappeared. I think it got messed up. So we'll move on past what I was going to say. Your other option, if that's going to happen, you maybe don't qualify for an income-driven repayment plan, or you can't find one that fits in your budget and you're still really having trouble. Or maybe you have certain circumstances. You are sick, you're going back to school, you are unemployed. They have options. Deferment or forbearance are both approved pauses to where you don't have to make your payments. Now, your unsubsidized loans in both scenarios will continue accumulating interest. And in deferment or in forbearance, both your subsidized and unsubsidized loans will continue accumulating interest. And that's really important to keep in mind, because if you do this and you don't make the payments, while it helps make sure that you don't default on your loans, which we never want to do, it can cause your balances to grow. So keep that in mind, and don't use this, use this sparingly. All right. And then if you have not switched to an income-driven repayment plan, if you have not talked to them about deferment or forbearance, and you go 270 days without paying your student loan, or you do not repay your loan according to the terms of the master promissory note, like say your payment was $300 and you're only paying them $150 without being on an income-driven repayment plan, or you were supposed to submit something for deferment or cancellation or discharge and you didn't do your paperwork on time, and it took 270 days for that paperwork to go in, you, after 270 days, are considered defaulted on your loan. And we really want to avoid default at all costs, which is why I am stressing to make sure that when this happens, when you restart your student loans, that you are evaluating those income-driven repayment plans. You are reaching out to your servicer if you're going to need a deferment or forbearance before those payments come due, because you definitely don't want the scenario where you default on your loans. So we're going to avoid default at all costs because they will garnish your wages. They will take your state and federal tax refunds. It will damage your credit. And then if you ever plan on going back to school, it will damage your abilities to get things like deferment, forbearance, or to get financial aid in the future. So it is very important to make sure that you avoid this. All right. If you have defaulted, there is hope. If you were defaulted before the payment pause started, there is hope. So let's talk about this. So when you have your loans, and this, to my knowledge, program is going to continue even after the Fresh Start program, which I'm going to talk about here in a second. You can rehabilitate your loans once. So if something happens, you default on your loans, you have this option to rehabilitate your loans. You make 9 on-time full monthly payments, consecutive months, and voluntarily. So if they are garnishing your wages, you're going to have to make a voluntary payment under, like, on top of whatever they're pulling out of your paycheck. On time, meaning within 20 days of your due date. And you can only do this once. I'm going to keep stressing. So that being said, you have to talk to your servicer. You can't just make 9 of 10 consecutive monthly payments. You have to actually get yourself on an income-driven plan with your servicer with the intent to rehabilitate your loans, right? Now, the good thing is with this Fresh Start program, which I'm going to talk about next, if you had previously rehabilitated your loans and you defaulted again, it is going to reinstate your eligibility once. So before the pandemic started, there were 7.5 million borrowers who were defaulted on their student loans. With this Fresh Start initiative that they implemented, that has recently been implemented and rolled out, the default is removed from everybody's credit who has defaulted on their loans, and they returned them to current status. They're given a 1-year grace period to get themselves all set up to successfully restart repayment and get into this Fresh Start program before they will start doing collections and just, hounding you again. Okay. The program will allow you to regain federal aid eligibility. It'll stop the collections that were going on. It will reinstate eligibility for maybe other government loans. It will allow you to rehabilitate your loans if you hadn't done that before. It will reinstate a person's access to your income-driven plans, which can help a lot of people from going back into default. It will also restore eligibility for folks who are trying to go for some of those student loan forgiveness programs that we talked about. And it will allow you to regain short-term access to deferment or forbearance. That being said, this is not permanent. You get a 1-year grace period to sign up for this in order to be a part of this and be able to rehabilitate your loans and get yourself back in good standing. Now, on the last slide of this, I have a link for all more information. So if you have a student or someone you know, or you yourself are interested in this program, you can have that link at the end of my PowerPoint. And again, I will send out the recording and the PowerPoint within about a week to everybody who is in attendance currently. So keep that in mind. Okay, some other things to keep in mind. Scams are rampant right now. Anytime something major goes on, big crisis, whatever, this happens. So keep in mind that a federal program is not going to charge you, right? All of these programs I've talked about are free through your servicer. So you don't have to pay a third party to do these things for you. They're not going to require an upfront payment or a monthly fee. They're not going to require you to sign over a power of attorney or some sort of third-party authorization to them to handle your information. They're not going to request your FSA ID and password. The only people who are going to need your FSA ID and password is when you log into studentaid.gov's website. They're not even going to ask you for your FSA ID and password if you call student aid. If they require any credit or debit card information, probably a scam. Any kind of high pressure or time sensitive like sales tactics may be a scam. Anything that's going to dissuade you from contacting your loan servicer. All of these things we've talked about, you have access to through your loan servicer and through the Department of Education for free. So keep that in mind. Anything that promises an immediate debt reduction or forgiveness, those programs do exist where you can get your student loans forgiven. We've seen that with PSLF. As of May, they had forgiven somewhere around $45 billion worth of loans. It was a pretty unreal number of how much PSLF has been able to forgive with that waiver and with folks getting into that program. So keep that in mind. Even things like disability discharge takes time. It's not going to happen all at once. There is a process. As with anything that comes from the government, it's going to take a little while. But also keep in mind if they tout a relationship with the Department of Education. Yes, your servicer on their website, they're probably going to have something that says authorized servicer for the Department of Education or something to that effect. But if you have any questions or anything seems a little sketch to you, you can go to studentaid.gov and look up who are their current contracted servicers. It's right there on their website. They got a little table that has their name, their website, and their contact information. And those are the only servicers that are currently contracted to work on your federal student loans. So keep that in mind. All right. That is all I have for you today. I know that was a ton of information. What questions do y'all have? I know we kind of went through all of this. I will send this to you. Please feel free. I'm going to stop the recording right now. If you have questions, please feel free to either hop on your mic or to hop in and into the chat and let us know what you're thinking.